How's it going, everyone? Last week I uploaded 2 case studies for the Amazon and Tesla options. In both videos we showed long calls that yielded 20 to 50x in a day. There's certainly home runs that don't happen too often. Stock option strategies are very versatile and could help you profit under various market conditions. Whether it's bullish, going up, bearish, going down, or flat, going sideways. In this video, I'll debunk 6 common myths for stock options so you can decide if it's worthwhile to learn these tools. Welcome to Money Insiders. My one and only goal is to increase your financial literacy by 1% every video. If you're new to this channel, do consider subscribing and dropping a like to show some support. We are so close to 100 subs. We'd like to take this time to thank every single one of you. Let's get started. You need a lot of money to play this options game. Not exactly. We can start buying option contracts for as little as $5. Of course we wouldn't want to do that since some brokerages charge $5 commissions just for you to get into that trade. For this reason, you want to bet $100+ in your contract to make it worthwhile. In this example for McDonald's, we see the contract is at 99 cents. As we mentioned in other videos, that one contract is equivalent to 100 shares, so that's $99 to purchase this contract. The current price for McDonald's is $211.37. We are paying $99 to own 100 shares of McDonald's, which would normally cost over $21,000. This contract shows February 21st, 2020 for a $250 call. The expiration date is 2 weeks away and the $215 strike price is less than 2% away. Say in the next couple days, the stock slowly climbed to $220. Your 99-cent call contract would be worth more than $5, equivalent to $500. That's quite powerful considering you only risk $99 instead of $21,000 to make the same $500. Number 2. Options are risky. I don't want to lose my shirt. Driving a car is risky. The coronavirus is risky. Life is risky. But if we take the time to learn how to protect ourselves, we can manage the risk, therefore accept the rewards. For the long option plays, the maximum amount of risk is in the price of the contract you initially purchased for. In the McDonald's example, it's $99, nothing more. But the upsides are unlimited. For the short option plays, we can structure various combinations of calls and puts as insurance, so you know exactly what your risk and rewards are prior to entering the contracts. Number 3. Options are only for professionals. It takes years to learn. Many of us can be intimidated since options are always associated with terms like leveraging and different iron condor, strangling butterfly strategies that are way too complicated. We think that one can only enter the options game after mastering the stock market, which in itself is not possible to achieve. Options can supplement your stock holdings either by hedging or making speculative one-time plays without risking much capital. The mechanism is same as trading stocks, buy and sell. Very simple. It's just the terminologies and strategies that has a little bit of a learning curve. Number 4. I don't have time to watch the daily market fluctuations. You certainly don't need to if you don't want to. Some would watch it if they're making a play for earnings, meaning they're expecting a huge swings during the trading hours. But if our time frame is 6 months to 3 years out, there's no need to even watch it for weeks. In this example for Tesla, we're looking at June 17th, 2022, $1,000 call. So the term is over 2 years and 4 months out. If you have conviction that the stock will shoot over $1,000 within the next 2 years, then any movements under $1,000 don't even matter to you. We are in the long game for substantial gains. Number 5. Homerun 10x to 50x samples are once in a blue moon. There are 500 S&P, 3,300 NASDAQ companies, and each of them report earnings 4 times a year. That's a total of 15,200 chances of these swings, if you're only making the earning home run plays. Then there are short squeeze rallies like the $1,000 Tesla run, which went up more than 100x. But in an ordinary month, any stock option could increase 200 to 300% easy. Make that on a couple of stocks, then you can accumulate the 10x you're looking for. Just think about what stock holding you can make 200-300% for the year. It's not typical without this leverage tool. Number 6. Options are only used for high flyer tech companies on the NASDAQ. I only invest in blue chip dividend growth stocks. Options are available on all the blue chip stocks and the NASDAQ tech ones. As mentioned in the McDonald's example, the long call option could give you leverage on any stock. Or you can use a strategy named covered call to harvest some premiums on these solid holdings. For example, suppose you hold 100 shares of McDonald's and you sold that $99 contract to the other buyer. If the stock stays somewhat flat or goes down a little, as long as it doesn't rocket past $215, then you pocket the $99 without any risk. This method is used by a lot of experienced investors to squeeze out more yields for their long-term holdings, possibly doubling or tripling its dividend payouts. After clarifying some of these common myths, are you excited to learn this new tool for 2020? Either to speculate for a few home runs during the earnings season, squeeze out a couple more percent for your long-term holdings, or hedge against a market correction. It'll certainly supplement our traditional buy and hold strategy. So what do you think? Have I increased your financial literacy by 1%? If yes, then consider subscribing, hitting the bell, and dropping a like. Otherwise, you can comment and let me know how I can create more value for you. Take care and have a good one.